I am OG John Original. Global markets are facing significant turbulence today as precious metals, equities, and energy prices experience dramatic swings amid escalating geopolitical tensions across the Middle East. This is a developing story with far-reaching implications for financial markets worldwide, and we will walk through each dimension of it in detail. In a span of just 80 minutes this morning, approximately $1 trillion was erased from the combined market capitalization of precious metals. Gold declined by 2%, wiping out roughly $740 billion in value. Silver saw a far steeper decline, falling between 10 and 11% within that same 80-minute window, accounting for approximately $260 billion in lost market value. To place that in context, this was not a gradual market correction playing out over hours or days. It was a concentrated, rapid movement, occurring largely before the New York trading session opened. Alongside the metals decline, broader market indicators were also under pressure. The United States dollar rose 1% on the day and is now challenging levels not seen since January 15th. German DAX futures declined 4%, NASDAQ futures dropped 2.5%, and S&P futures fell by 2%. Meanwhile, European natural gas prices surged between 20 and 22% on the day, following a 50% gain recorded the previous session, a cumulative rise of over 70% across just 2 trading days. Adding to the global market stress, South Korea's KOSPI index, which had been closed Monday for a public holiday, reopened today for the first time since United States and Israeli military action against Iran began. The index immediately fell more than 7%, erasing approximately $270 billion in market capitalization in a single session, its largest single-day decline since the yen carry trade crisis of August 2024. To understand why precious metals moved the way they did today, it is important to examine both the macro environment and the specific dynamics within silver and gold markets individually. On the surface, the direction of silver appears to contradict the broader geopolitical backdrop. An expanding conflict in the Middle East, systematic targeting of oil infrastructure, and collapsing energy routes would traditionally be expected to drive safe haven assets higher. Yet silver fell by 11%. The explanation lies in the composition of silver's demand profile. Silver carries approximately 50 to 60% industrial demand, spanning sectors that include solar energy, electric vehicles, consumer electronics, artificial intelligence infrastructure, and defense manufacturing. When energy disruption of this scale enters the market, algorithms price in a growth scare and move against every industrial metal simultaneously. Gold, which carries no significant factory or industrial demand, held comparatively better. The established order during growth fear environments, according to market behavior, runs as follows. Gold is hit first, followed by silver, then platinum, and then copper. The more industrial the metal, the harder it is struck until growth uncertainty subsides. However, an 11% decline concentrated into 80 minutes goes beyond what macro explanations alone can account for. This brings the conversation to where silver is actually trading across different markets simultaneously, because those numbers tell a very different story. Western spot silver is currently priced at $79. Western futures are sitting at $81. By contrast, Shanghai spot silver is trading at $91, and Shanghai futures at $92. That represents a $12 premium still intact on the Shanghai side, even after the 11% crash recorded in Western markets. The gold-to-silver ratio in paper markets currently stands at 62-1. When measured against physical and production realities, that figure sits in stark contrast. The mining ratio, meaning how much silver comes out of the ground relative to gold, is 1-7. The COMEX vault ratio stands at 1-11. The LBMA vault ratio is 1-3, and above-ground available supply sits at a ratio of 1-1. The paper ratio at 62-1 is, by those measures, significantly disconnected from every physical and production benchmark that exists. Further adding to that picture, the Shanghai Gold Exchange released its 7th weekly report, covering the period of February 24th through February 27th. In that report, silver inventory data was entirely absent. Gold volumes were reported as normal, but every silver inventory line was blank. This is the same exchange that has published detailed silver stock figures on a weekly basis. The absence of that data, during a period of historic price movement and active geopolitical disruption, has drawn attention from market observers who note that the timing of such an omission is notable. Separately, the Shanghai Futures Exchange suspended 5 additional groups of accounts today for trading violations. Mid-session account suspensions during an 11% daily price move indicate that irregular positioning activity was identified and acted upon by exchange authorities. 2 separate actions by 2 distinct Chinese market institutions on the same trading day, an inventory data blackout at the Shanghai Gold Exchange, and account suspensions at the Shanghai Futures Exchange, occurred within the same session. Turning now to the COMEX, physical inventory movements on Friday provided additional data points that market observers are tracking closely. A total of 2.8 million ounces of silver were withdrawn from COMEX silver vaults in a single session. Those withdrawals were recorded simultaneously across 4 separate vault locations: Brinks, CNT, Delaware, and JP Morgan. The detail that carries particular significance within that figure is the relationship between eligible and registered silver categories. Eligible silver is declining at a faster rate than registered silver is rising, meaning that the total COMEX silver inventory is still experiencing a net decline overall. A rising registered silver headline taken in isolation does not reflect the complete inventory picture currently unfolding at the exchange level. Physical supply stress indicators are also moving in a direction that contrasts with the decline in paper prices. Over the preceding several days, silver lease rates have been moving higher. The swap has been turning increasingly negative. Rising lease rates indicate that the cost of borrowing physical silver is increasing. A negative swap reflects that futures markets are beginning to price in backwardation risk. These two indicators taken together are recognized as early warning signals for physical supply stress. The paper price moved to $79. The physical stress indicators moved in the opposite direction. The conversation now turns to institutional positioning in the silver market. Jane Street is currently the largest holder of the BlackRock Silver Trust, having purchased 20.6 million shares within a single quarter. That figure represents 3.6% of all outstanding shares in the trust. More than 87% of Jane Street's $662 billion portfolio is held in options. The firm generates profit by creating and trading volatility through the use of significant leverage. The described structure involves building a large position in an underlying asset, running a substantially larger options trade alongside it, then reversing to generate returns. In India, regulators formally documented how Jane Street manipulated the cash market in order to profit from derivatives positions. A lawsuit filed by Terraform Labs accused the firm of employing similar tactics during the $40 billion Terra collapse. A pattern of daily 10 a.m. Eastern Time selling in Bitcoin was also identified as sufficiently consistent and mechanical that it became a recognized pattern within that market. That pattern ceased following the filing of a public lawsuit. The physical silver backing Jane Street's SLV position is held by JP Morgan, a bank that has already paid nearly $1 billion in fines related to precious metals market manipulation. On the energy side, several significant developments are compounding the pressure across global markets. The port of Fujairah, described as the United Arab Emirates' only significant oil shipping route that bypasses the Strait of Hormuz, was struck by a large explosion. Iraq has shut down the Rumaila oil field, identified as the world's second largest, which produces 1.5 million barrels per day and accounts for approximately 30% of Iraq's total oil output. When tanker movement through the Gulf is restricted, storage capacity fills. When storage fills, production is halted. That sequence is described as currently underway. Oil prices moved from $72 to $76 today, despite the broader market sell-off, with physical supply pressure overcoming paper market pressure in that specific asset. The United States has issued warnings regarding imminent Iranian missile and drone attacks targeting Dhahran, Saudi Arabia, which is home to Saudi Aramco, and sits atop the largest proven oil reserves in existence. Israel has indicated that Saudi Arabia may be preparing to strike Iran directly. China has officially opposed United States and Israeli military action. United States President Donald Trump stated publicly, and this is a direct quotation from the original source, "We haven't even started. The big wave hasn't happened. It will come soon." 15 countries or military installations have been struck. The largest Saudi refinery is reported as already offline. Qatar's liquefied natural gas supply is described as gone. As this broadcast has detailed, today's market movements involve a convergence of factors spanning geopolitical escalation, institutional positioning, physical inventory dynamics, and broad liquidity conditions. Before summarizing the physical market indicators that remain in focus, it is important to acknowledge the risk factors and technical developments that present a counter-perspective to any singular narrative around precious metals. Silver broke down technically today. The 150 exponential moving average on the hourly chart did not hold. In a full liquidity squeeze environment, even assets with sound underlying fundamentals are liquidated to raise cash. Western mining stocks are not following Chinese mining stocks higher, and that divergence has been noted as a warning signal regarding where institutional commitment currently stands. If the United States dollar continues pushing higher from current levels, metals face additional headwinds in the near term. These are documented risks that exist alongside the physical market data and deserve equal acknowledgement in any complete assessment of current conditions. With those risk factors on record, the physical market indicators that were in place prior to today's price decline remain unchanged. The Shanghai Gold Exchange has gone dark on silver inventory data during a period of peak market stress. 2.8 million ounces departed COMEX vaults in a single Friday session, drawn simultaneously from 4 separate vault locations. Silver lease rates are rising. The swap is turning increasingly negative. The gold-to-silver paper ratio remains at 62:1, while the mining ratio sits at 1:7, the COMEX vault ratio at 1:11, the LBMA vault ratio at 1:3, and above-ground available supply at 1:1. The chief executive officer of Scottsdale Mint disclosed live that a publicly traded company is actively adding physical silver to its treasury management at this time, describing the amount as unprecedented at this price level. That represents a category of institutional behavior. Public companies treating physical silver as a treasury reserve asset that has entered the market conversation. On the broader geopolitical front, the situation across the Middle East remains active and fluid. 15 countries or military installations have been struck. The largest Saudi refinery is offline. Qatar's liquefied natural gas supply has been disrupted. The port of Fujairah has sustained a significant explosion. Iraq's Rumaila oil field, the world's second largest, is shut down. United States warnings regarding imminent Iranian strikes on Dhahran, Saudi Arabia remain in effect. European natural gas prices have risen more than 70% across 2 consecutive trading sessions. And the United States President has publicly stated that the actions taken to date do not represent the full scale of what is anticipated. Global equity markets are reflecting the weight of these developments. South Korea's KOSPI recorded its largest single-session decline since August 2024. Germany's DAX, NASDAQ futures, and S&P futures are all trading lower. The United States dollar is challenging its highest levels since January 15th. Liquidity conditions are tightening, and asset correlations are compressing, with equities, bonds, and metals selling simultaneously while the dollar rises. Only oil is holding ground within this broader regime, driven by physical supply disruption that is overcoming paper market pressure for now. This has been a comprehensive breakdown of today's developments across precious metals, energy markets, global equities, and the geopolitical landscape shaping them. The data referenced throughout this report is drawn from documented public sources, including exchange reports, regulatory filings, vault inventory records, and official public statements. As conditions across these markets continue to develop, we will bring you further reporting as new information becomes available. That is the full picture for this broadcast. We thank you for watching.